Joining me now is Matthew Bartolini, Managing Director, Global Head of Research Strategist, StateStreet Investment Management. Great to have you here, Matthew.
Yeah, thanks for having me.
So we're wrapping up the month of March. We're wrapping up Q1. It's been a rough start to the year. Stocks are bouncing today, but do you look overall at the red arrows that we've been seeing as a typical reset or something bigger?
Well, I think it is part of a typical reset where you had risk assets being repriced as a result of the significant volatility from the geopolitical conflict in the Middle East. So you saw risk assets, risk premiums widen out. As a result, you saw equities fall, you saw bond yields rise as there is now a greater premium for that inflation risk that bonds do have to bear. So this somewhat the first order impact wasn't so much, it didn't feel orderly, but it made sense in terms of what we were seeing in terms of the energy shock, that supply, the reaction function that does have to inflation, elevated inflation potentially, lower growth. Equities don't really like high inflation and low growth, so you see them selling off. Bonds don't really like elevated inflation, so you see them selling off, and that's just your natural risk premium widening.
So today's pop that we're seeing, if it holds, do you look at that as just a typical relief rally then, or could it be the start of something more durable? Because there's hope that the war is near an end, but we don't know.
Yeah, so that's the problem right now is we're trading based on headlines, and that creates so much anxiety and noise to really get a strong signal because you've had so many different headlines that are basically contradictory to each other. And which one is going to be the one that drives the market or in fact drives growth, inflation, fundamentals? That's the big thing. It's how have all these actions impact the type of cash flow that the economy can do, as well as companies. So the day-over-day headlines, it's just noise. I would try to look through those and maybe take a longer-term picture and see how these events maybe impact that macroeconomic backdrop, which has been rapidly repriced and transformed, not just this month, but over the last year as well, which that really lends itself to having more balance and resiliency and just defense in portfolios writ large.
So what is it that's actually driving this market, though? Because we saw pockets of weakness, especially in tech, even before we were talking about a war in Iran, even before oil was spiking. If you take that out of it, can you make the case that this is a market that should head higher?
Well, I think part of the problem is you've had a redrawing and rewiring of your macro backdrop over the last 18 months where we've changed from an economy of global cooperation to one more of insular and national security defense prioritization, not just from the US, but other countries as well, in reaction to the US and their sort of, push forward on modern mercantilism type of policies. So when we take a bigger step back, we did see some weakness ahead of it. A lot of it had to do with more stubborn inflation, concerns that the Fed wasn't going to lower rates as strong as maybe the market had wanted because of that stubbornness in inflation, and a slowing or softening of the labor market that was perhaps going to impact some of the consumer and consumption trends in the US, and that's why we see consumer sentiment actually even now more nosediving because of the impacts of the war in Iran. But for tech, a lot of the problem there is just all of this massive capital expenditure spending on the build out of AI. You're using so much of that cash flow to invest in the productivity miracle far out on the horizon, but the cash flow from that investment is not being realized in the near term. So investors were weighing of how much CapEx they could take in terms of when they get that growth to come back. And now it's being compounded by the fact that rates are higher, and that means a higher discount rate for those expected cash flows, which from a finance 101 perspective, higher discount rate means lower prices to actually equate the long-term growth.
So easier to make the case that all of that is priced in at these levels, or that this is a correction that could become a bear market?
So I think that's sort of where you see these myopic relief rallies. These, what we're seeing today, where you see positive news and it's a reason to buy, that perhaps there will be more clarity out in the future because the market has re-rated so strongly, where valuations were elevated quite so leading up to the conflict, and now you're coming in more around averages from historical level. I think the S&P is trading around 19 times earnings. Long-term averages, I think, around 17, 18. So you're not too stretched. At the same time, fundamentals, and this hasn't been the other shoe to drop yet, fundamentals continue to be revised higher. So typically in Q1, your full year earnings estimates are usually revised lower by about 1%. What we've seen this quarter is 2026 earnings per share estimates be revised higher by 4%. A lot of that is driven by those tech conglomerates and the AI build out. But also you've seen energy stocks as a result of the price shock that we've seen from the Iran conflict. Those have been revised higher as well, same with materials. So fundamentals are still pricing in maybe a stronger growth environment. Double digit, in fact, would be 6 consecutive quarters of double digit growth, which is really strong. So that's why when you get some positive optimism from a macro perspective, there is that bump higher. The problem is, day over day, that those headlines are massively changing.
So you called that a shoe that hasn't dropped yet. Does the market have it wrong? Are the fundamentals not as solid, or is that going to eventually be a headwind versus a tailwind?
That's the biggest risk. So in March, we were trading within this macro vortex. There wasn't so much fundamental news to come out and impact the market, inflict it higher or lower based on how companies are performing. We're now outside of that vortex where fundamental reports will start to come in the month of April, and you see these revised higher expectations. So the bar has gotten higher for stocks to jump over. Now, last quarter, you saw roughly about 70% of firms beat their earnings, which is above the long-term historical average, but below recent trends. So if companies can't meet these lofty expectations, they're likely to be punished. Now, the big risk is a beat, but guide lower. So you beat on earnings, but then a company comes out and says, well, the macro environment's becoming more unstable, inflation's going higher, prices are going higher, it's going to eat into my margins a little bit more, consumption might be impacted, so I'm actually going to guide a little bit lower for the next couple of quarters, so it's easier for me to beat those earnings. That's the big risk. So you do have asymmetric outcomes for the marketplace because you do have a risky macro environment that's inducing a lot of volatility. The one thing that could be the saving grace is if those fundamental reports come out and they're just strong. They've been strong for 6 consecutive quarters, and the market wants to see if they can sort of drive through this near-term macro volatility and deliver some fundamental strength.
Is there any reason to think that they shouldn't be strong?
Well, part of it's on the tech side. So on the tech side, that AI build-out has taken a lot of capital expenditure spending. It has seen these companies tap into debt markets. The expectations have been continuously revised higher. Now, what's interesting is the Magnificent Seven stocks, they're actually down double digits to start the year. So even though their expectations fundamentally have been revised higher, their prices have gone lower. So you
would think that maybe that's a lower bar, though, versus a higher bar, no?
On the earnings, it's a higher bar, but their price has gotten better to where those forward-looking earnings growth expectations are now priced in a more, say, conducive valuation, right? It's not, I'm not paying eye-watering levels for future cash flow that might be way off in the distance. The price has gotten a little bit better. However, there's still some risk to it because there's a lot of volatility. If all of a sudden the market is reading through some of these Mag 7 reports and their CapEx numbers are coming down because of maybe near-term concerns, that could be a bad signal for the market because they're like, oh, you're not spending as much as we thought you would on this productivity miracle that is AI. So there's just a lot of risk built into the marketplace, and it is being compounded by the macro sensitivities because even before March, the market was trading sideways based on how will the promise of AI manifest itself in terms of actual real economic growth today in an environment where you still have stubborn inflation, policy rates that are largely generally restrictive, and a softening labor market. So it wasn't like we entered into the Iran conflict with a robust amount of fundamental support from the broad-based market. There was some questions.
So let's get into flows and talk about where you're seeing the strongest flows within equities specifically, and how does AI play into that?
So AI plays into it in, say, one aspect where there's been inflows. So if we look at it from a sector perspective, in March, we saw utilities sector ETFs have about $1 billion of inflows. Some of that is related to just the defensive bias that utility sectors do have. There are also their relationship to the energy complex in terms of electricity consumption and generation. But then also that electricity consumption and generation is so valuable to the build out of AI. That's why you've seen utilities stocks do well this year. They're one of the only two sectors, energy being the other one, that is trading above its 50-day moving average. Everyone else is down. Now, also you have utilities inflows in the sectors, over $10 billion over the last 12 months as investors have been positioning for this AI build out from an infrastructure perspective. Because while all these hyperscalers in the tech and communication services sectors are spending all this capital expenditures, and those ones might be the growth bearers at the end, be the winners, the infrastructure is being built out now. So all those CapEx dollars are coming down into utilities, into industrials firms. Industrials have had positive flows over the last 3 months and year to date as a result of this cyclical build out, but also their relationship to the defense ecosystem of aerospace and defense stocks, which have done quite well. And I'd say the last area that we've seen really strong concerted inflows into natural resource equities. So if you combine energy and materials together, they have roughly about 17 billion of inflows this year alone. Energy is at a record of $11 billion over the past 3 months, which is a record over any 3-month time period, and coincide with the strong price performance, but also from what we've seen of strong upgrades. Energy sector has the strongest upgrade-downgrade ratio out of any sector so far over the last 3 months, which actually makes a lot of sense, just given what we've seen from a geopolitical construct where energy is at the forefront.
So when you look under the hood, what are flows telling you about how investors are actually positioned versus what sentiment is like, what they're saying?
So what's interesting is leading up to the conflict, and even so far right now, when we look at it from a geographical perspective, a lot of investors coming into the year and coming into even 2025, ago a year before, were heavily concentrated in U.S. equities. That's starting to broaden out a bit in 2025 as non-U.S. equity markets outperform the U.S. And in 2026, that really accelerated itself where basically they were one for one. They were matched, basically where we are now, it's roughly I think 80 billion to 80 billion or something to that effect. Don't
U.S. to international.
Yeah, the numbers are essentially the same where we are now in the last 3 months in terms of where flows are. And that's kind of interesting because the U.S. market's so much bigger. So investors were trimming some of that underweight to non-U.S. equities and seeking to improve their regional diversification. And I think that's an area of interest even as we go past the time period in March, just because investors were so underweight U.S. equities leading up to this marketplace. And we've seen non-U.S. equities, so far 78% of non-U.S. equity non-U.S. equity countries have outperformed U.S. equities. So there's some durability from that performance trend.
So continued interest in international. I was also taking a look, you saw record inflows into short-term government bond ETFs, and then you said long-term government bonds saw $2 billion in outflows. Is that a play it safe trade? What should we be gauging from that? And how should we be thinking about fixed income as competition to equities? Is it a real competition at this point, given it seems like investors are trying to hide out?
Well, I think that's the thing. So even just taking a high level look at flows in March. So flows in March for the whole US listed ETF industry was about $100 billion. It's a big number, but it's actually 35% less than the trailing 12-month trend. So basically it was averaging 160 billion. So that shows me some restrained buying behavior amid this uptick in volatility. Now, as we said, there have been some inflows in areas like natural resource equities and sectors, but one of the more noteworthies is into that short-term government bond space. They took in a record $28 billion in March as investors sought to de-risk amid the conflict and sort of rotated back into more cash-like vehicles, which are also potentially able to benefit for that repricing of Fed policy, where now you're looking at maybe one rate cut or even none. Before you're looking at maybe 3 to potentially even 4. So
and maybe potentially a rate hike. It seems like that's been kind of repriced, but it
seems like anything's on the table, and that creates a lot of uncertainty and angst. So investors have gone into that shorter term duration of the government bond space really en masse. Now on the long end, investors had $2 billion of outflows in March, but they've been in outflows over the last 3 months, 6 months, and 12 months as investors have gravitated away from the long-term bond because of some structural biases as a result of where we are from an inflation perspective, stubborn inflation. You also have widening term premiums, so long-term bonds, they're charging a premium relative to short-term bonds, and part of that is a result of rising fiscal deficits. And as a result of this conflict, if it continues to be prolonged, it will only likely need more debt-fueled spending to sustain some of the defense spending needed to combat the war in Iran, which will have a negative reaction to the deficit, which could potentially then lead to higher term premiums on the long end and losses for long-term bonds, even if the market starts to decline, which is sort of counterintuitive. If you're trying to play defense, you want to own that long-term treasury. That's why we think owning that more intermediate term can give you some of that reaction function in terms of downside growth, but without having to endure the inflation premium and then the overall deficit premium too.
So what's the takeaway, just the Main Street takeaway? How defensive are investors right now? Are they exiting, or are they just repositioning? How worried do you think they are?
Yeah, so I would say the buying behavior is been suppressed. So a little bit constrained because of the volatility. Stocks are down. You have, Nasdaq's in correction. The S&P is teetering in that type of space. Obviously we're up today, so we're probably going to navigate around that. Below the 200-day moving average, that tend to kind of look like a bottom too, but don't want to call that with all this volatility. I would say for investors in this type of marketplace, don't predict. Try to prepare. Because predicting what's going to happen next based on whatever headline comes out, and those headlines have been inherently volatile in all over the place, having that ability to prepare across a wide range of assets is more beneficial than predicting which shoe will drop next.
As I've been trying to get you to predict, tell us just quickly, how do we prepare then?
Well, I think having a broad mix of assets. It sounds very boring, but actually there's ways to be tactical because many are probably overweight U.S. equity, overweight tech, and FANG stocks. And so we're seeking that regional diversification, owning emerging market equities, which is also a way to own AI, given that there is some AI transmission mechanism in terms of South Korea, Taiwan, China, and their relation, India, but also just different macroeconomic environments in EM. But then also you have owning global nominal bonds too, owning commodities. A lot of investors are underweight commodities, gold as well, those areas. Just something more than concentrated U.S. equities. I think that's one of the things that investors should take away because so many are concentrated in those. And that could even just be owning more natural resource equities too, because those are very underweight in your broad benchmarks.
Okay, that's helpful. Before we let you go, we like to play a rapid fire game of this or that. This is your first time playing with us. Are you ready?
Yeah,
all right,
looking forward to it.
Quick questions, quick answers. Here we go. Market, resilient or fragile?
I would say the market is more fragile right now because the senses have been frayed a bit.
Correction or something more serious?
I would say correction because it's not as ominous.
So today, relief rally or start of a recovery?
I would say relief rally because I would hard to predict the longer term.
Investors, swapping sectors or taking chips off the table?
I would say swapping sectors. You had a lot of tech before, now you're going more natural resource.
Flows, repositioning or exiting?
Repositioning.
Where are the heavy hitters hiding out? Quickly.
I would say short-term government bonds.
Buy the dip or wait for lower?
I think any day is a good day to be buying to compound growth over a long time frame.
Lean into risk or stay defensive?
I would say earn risk in a more balanced way.
Stay invested or raise cash?
Stay invested. It's one of the truths of investing.
Retail, buying or backing off?
I would say they're more apt to be buying right now.
Institutions, adding risk or pulling back?
Again, hard to tell, but I would probably say they'd be a little bit defensive on the more tactical traders.
Mega cap tech or the rest of the market?
I would say rest of the market because everyone owns mega cap tech.
US or international?
I would say international because everyone owns the US.
Developed or emerging markets?
I would say emerging markets because the growth profile is a little bit stronger.
Fed, on hold or forced to move?
That's a tough one. I think they're probably going to be forced to move.
Rates heading higher or lower?
From a Fed policy perspective?
Sure, Fed funds rate.
Fed funds rate, I would say, if anything, lower.
Equities or fixed income?
Equities.
Stocks or cash?
Stocks.
One word to describe the market for the rest of 2026.
Uncertain.
One word to describe how you're feeling about the market for the rest of 2026.
Confident.
All right, we'll leave it there. Matthew, always a pleasure. Thank you so much.
Yeah, thank you.
That's Matthew Bartolini, Managing Director, Global Head of Research Strategist, State Street Investment Management.